Hi, my name is Denver Noes with Wealth for Life. Thanks for taking the time to watch this short video. One of the questions I get all the time is what are the main differences between whole life and index life and which is better? Well, the answer, of course, it depends. They both have good features and they both work better in certain situations. But I'll give you some of the basics for what you use in comparison. If you look at really three basic areas, and I would say you start with guarantees, then you would look at upside, and then you would look at flexibility. Now for index life, we would look at on the guaranteed side, which one's going to have a higher guarantee, index life or whole life? And if we're kind of on this spectrum, with this being more on this side and this being less on this side. On the guarantee side, you're going to have less guaranteed on the index side, so the IUL, Index Universal Life. You're going to have more guarantees on the whole life side. That's certainly one of the advantages of whole life is they're very stable. The companies are secure. They've been around forever. And you have a very strong guarantee. When we look at upside potential, again, if we're looking at less upside on this side, more on this side, you're going to have more upside on an Index Universal Life. You're going to have the gains and interest credited in the policies based on market indexes. A lot of them have very high double-digit growth potential and have had some very big years in recent years. I would say in 2013, the highest gain I saw in an index life policy was around 26%, which is a pretty good yield. And you're going to have less upside on the whole life because they're going to pay out their dividends. A lot of times it's going to be in the 5 to 7% range. Is kind of what you're going to max out at on the upside side. The next thing is flexibility. Again, if we're looking at less versus more, the index life policies are going to have more flexibility. They're by nature called flexible premium index universal life. So you can actually change your premium on a year-to-year basis and adjust what you're paying into the policy. So the IUL is going to have more flexibility. Whole life, you generally have this planned premium. It's going to stay fixed. You need to pay it every year. And that's the whole life side. You can make changes, of course, but it can take some work and it can cause some problems in the policy and cause some problems with the guarantees. So if your goal is out there to kind of have more upside, have more flexibility, IUL is going to be better. If your goal is to, you want stronger guarantees and you're going to pay those premiums, the whole life is going to be better in that situation. The next thing we want to look at, though, is also, kind of what they go on, what it looks like when you start looking at cash value. There was a good study that one whole life company did comparing themselves to about eight of the other top whole life companies. So in this comparison, you have 9 whole life companies. They ran certain parameters using a 45-year-old male, best risk class, $1 million in face. And they looked at what the cash values and internal rate of returns would be at year 10 and year 20. And so in this particular scenario, when we looked at the whole life, and we'll do the index life as comparison on this side, the best whole life company in this parameter of this individual and the premium numbers that they ran was that at year 10, the cash value is about $180,000, on the whole life side. Premium again was around $16,000 to $17,000. They were calculating per year going into the policy. So that's one of the issues with whole life policies, is it takes a while to break even. In this particular instance, based on the premium, the client hadn't made a whole lot of money in the first 10 years. They were just kind of paying into the policy. On the index universal life side, that same kind of parameters that we put together, the cash value at year 10 was around $295,000. Quite a bit more, again, hypothetical numbers on both cases based on the historical back testing and current assumptions. So keep in mind that all these numbers are hypothetical, but some pretty good data was used to put them together. But this is a plus of nearly $115,000 in cash on the IUL side at year 10. You go out to year 20, and the whole life number, the cash value ran out to around $577,000. Quite a bit of increase, during those next 10 years. The index life side, over 20 years, the cash value went up to around $719,000, in this estimate. So, about $160,000 more in cash value. And again, this study that was done by the whole life companies, kind of evaluating themselves, put the internal rate of return, which internal rate of return is net, internal rate of return after all fees and costs are taken out. One of the best measures of growth. They have the whole life policy at 20 years pegged at about 2.91% is the 20-year internal rate of return. where in this example on the IUL side, you were looking at 6.04%, as an internal rate of return. So quite a bit higher due to we have more upside and flexibility on that IUL policy. That's actually about 52% more return, 52% higher yield than this. So then when it comes to if my goal is to maximize income, and knowing that, okay, I have less of a guarantee, I still have a guarantee against market losses because IULs have that floor that protects you. But if I'm trying to maximize income, and I'm saying, you know what, I want to get as much income as I can, I'm willing to take on a little more risk. You still have, some pretty good confidence in back testing, and we've seen that, hey, these policies do perform pretty well, but I have a much higher potential to create a much higher income, using the index life, based on those numbers. Now, again, the trade-off is back to that risk thing. So how do you kind of sum it all up? Well, if I want more guarantees and I want, that steady kind of policy, the whole life is going to be better. The index life is going to do it differently. They're going to have more upside, more flexibility. What I always compare it to is cars. If you look at, a 1965 Cadillac, it's a pretty neat car. You got a lot of steel moving. If you go out there and you run into another car, you're going to destroy them. You're going to run them over. But, they're a little slower. They're not quite as flexible. Then you take a look at, a 2014 Cadillac XTS, twin turbo, 410 horsepower. It's going to go 0 to 60, I think, in about 5.2 seconds. Is it still safe? Is it as safe as the old Cadillac? Well, you have, I think there's 10 airbags in those things. They have, radar technology now and all kinds of sensor technology. Pretty safe, pretty easy to get around. It's just a more modern version. And that's what you see in whole life. Whole life hasn't particularly changed a whole lot in the last 30, 40 years. Index life has just taken advantage of a lot of the advances we've had in options and hedging strategies. And they've been around long enough now that you can actually see performance and track record, which I think was something that had discouraged a lot of whole life agents in the past from selling index universal life because it was newer. But you even see whole life companies now coming out with index universal life. So again, it all depends on what your goals are going to be for the strategy. But this is kind of a good intro overview. And if you want some of the documentation and some of the research that we use to put this analysis together, just send me an email at denver@wealthforlife.net. I'll be happy to shoot it over to you, and let me know if you have any questions.